Well, I've got some good news. The Westpac Melbourne Institute Index of Consumer Sentiment actually lifted by 3.9% in September. That follows consecutive falls since November last year, totaling 23%. And that's despite the fact that we've seen inflation continuing to rise and we've seen the Reserve Bank raise interest rates by another 50 basis points. When we look at history, there's a message in this result, however. Basically, we've only seen the index fall sustainably below that 80 level during periods of deep recession. So in the early 1990s and of course the more shallow recession in the early 1980s. Periods of major economic dislocation that we saw in the global financial crisis and in COVID, it only dipped below 80 for 1 month. So the 80 is quite an extreme floor level. And the difference between this period and those earlier periods of deep recession, of course, is the labour market. So in those earlier periods, people were incredibly pessimistic and the labour market was unravelling. Unemployment got to around 11%. And when we look at our particular measure of confidence in the labour market, it is now 60% higher than it was during those periods. So that level of 80 does represent a historical floor to the index. And I think that's the main message that we're seeing today. I'll be very cautious to suggest that we've seen a major turning point and a major period of an upward surge in confidence. However, there were a couple of aspects over the last month that may have helped confidence. The first one, of course, is that over the last 2 months, petrol prices have fallen by 17%. So that fear of inflation may perhaps has eased. And secondly, even though we saw the Reserve Bank raise the cash rate by 50 basis points, we noticed that confidence before the announcement was actually lower than it was after the announcement. And that suggests that people were concerned that the increase may have been greater, or it may be that they're becoming conditioned to rate hikes. The survey indicated that 57% of respondents after the rate hike still expect rates to go up by 1% or more. That compared with 73% back in July, but of course that was off a lower base. During this survey, we also asked people about what major news items are affecting their thinking. Hasn't changed much from the last 3 months. Very much inflation was number 1, economic conditions was number 2, interest rates number 3, and global economic conditions also figured prominently. And of course, the view on all of those was very deeply negative. The one surprise was that the question trade unions and strikes, which has basically been scoring 0 for the last 20 years, reached 4.7%, and that's the highest we've seen since 1985. So that's something to watch in terms of what came out of the summit earlier on in the month. The other big news, of course, was around housing. So the housing story improved. Question is now a good time to buy a dwelling was up by 2.3%, but it's still down 40% from its peak back in November 2020. But the thing that did surprise us was that we saw a 3.6% lift in the outlook for house price expectations. That index is off around 30% over the last 6 months. But to see that turning point and to see the index holding above 100 was somewhat of a surprise. But there were some big differences in terms of the messages from the states. So for instance, in New South Wales, there was a lift of 6%, in Victoria, a lift of 33%. But in Queensland and Western Australia, the states that have been doing much better in this down cycle, we saw falls of around 13% each. We now have a situation where, in terms of the actual level of expectations, Queensland is the most pessimistic of the states, and the other 3 are in slightly optimistic territory. So what does this all mean for the economy? Well, last week we confirmed our view that in 2023, economic growth will slow to 1%. Consumer spending that's currently running at around 6% will slow to about 1.2%. And you've got to remember the various ways in which higher interest rates affects the economy. About a third of households have a mortgage, about a third are tenants, and about a third own their properties outright. So for those with a mortgage, of course, the higher interest rates affects their budget. For those that are tenants, are affected indirectly by the impact of interest rates on their landlords. And for those that actually own outright, they'll be affected by a negative wealth effect. Now, we've already seen house prices falling by 4%, and we're expecting another 12% between now and the middle of next year. There's also, of course, this very deeply pessimistic consumer sentiment that we currently have. 84 is still a very, very low level. And of course, the impact upon new activity in housing will be impinged by higher rates and the restriction on how much people can borrow under the context of higher rates. What does this mean for the Reserve Bank? Well, we believe that the best approach for the Reserve Bank now is to have moved very rapidly to what we would call neutral rate settings, the so-called neutral settings. We believe that they've now reached that point. And we think now, because rates have moved so quickly, there is what I would call treacherous lags in the system. We haven't really given much time for the economy to adjust to these much higher rates. And I think the central bank would now do well to continue to raise rates, but at a slower pace. So moving from 50 basis point moves to 25 basis point moves, but to continue to send the message that there's more rate hikes in the pipeline. And we're expecting in October for the rates to go up by 25 basis points, then in November the same, then in December the same, then in February the same. By then, the evidence of those lags will be clearer, and we expect that they will be indicating a much slower consumer environment and, of course, further falls in house prices and other impacts upon the economy for higher borrowing costs for businesses, etc. So an interesting survey, but I don't believe it's the beginning of a strong rebound in consumer sentiment. I think we have to respect those flaws that we can see in the index around that 80 level, and a little bounce off that floor to me does not suggest that the consumer sentiment is going to continue to rise in this environment where inflation is rising, where interest rates are rising, and where there's so much uncertainty around the world economy. Thanks very much.